Picture this. You're sitting on a beach, sipping your favorite drink, and while you're relaxing, your money is working harder than you ever have. Sounds like a dream, right? Well, that dream is exactly why so many people are turning to real estate as their path to financial freedom. But here's the catch. When most beginners hear real estate investing, they imagine buying a house, dealing with tenants, fixing leaky toilets, and stressing over late rent checks. That's one way, but it's not the only way. In today's video, I'm breaking real estate investing down to its simplest form. We're going to talk about the two main approaches anyone can start with: real estate investment trusts and rental properties. By the end, you'll know exactly which path might fit your lifestyle, your budget, and your long-term wealth goals. Before we dive in, make sure you hit that subscribe button and turn on the bell, because here we make money topics simple, clear, and beginner-friendly. 1. Why real estate is a wealth builder. Let's start with the big question. Why is real estate such a powerful tool for building wealth? For decades, millionaires and even billionaires have turned to real estate for one big reason. It creates multiple streams of income. Think about it. You can earn cash flow, the money left after paying expenses. You can build equity. As you pay down a mortgage, you own more of the property. You can benefit from appreciation. Property values generally rise over time. You get tax advantages like deductions and write-offs that lower your taxable income. Now, most investments like stocks give you just one or two of those. Real estate gives you all four. That's why it's often called the ultimate wealth-building machine. 2. What are real estate investment trusts? Now let's talk about the first option. Real estate investment trust is like a stock that owns real estate. Imagine a company that buys apartment buildings, office towers, shopping malls, or even data centers. When you buy a share of that company, you're indirectly owning a piece of that real estate. Here's the beauty. You don't need thousands of dollars to get started. Some real estate investment trusts can be bought with as little as $10 or $20. You don't have to worry about tenants or repairs. They pay out dividends, which means you get regular income, often quarterly. Example: if you invest $1,000 in a REIT that focuses on apartment complexes, you'll receive a small share of the rental income collected from all those apartments. It's real estate investing, simplified. 3. The benefits of real estate investment trusts. So why might you choose this? Accessibility. Anyone can start, even beginners with small budgets. Liquidity. Unlike physical property, you can sell your real estate investment trust shares quickly, just like a stock. Diversification. A single real estate investment trust might own dozens of properties, so you're not putting all your eggs in one basket. No headaches, no fixing toilets, no chasing rent. That's why REITs are often the perfect starting point for beginners who want exposure to real estate without the stress. 4. What are rental properties? Now let's switch gears to the more traditional path, rental properties. This is the strategy most people picture: buying a house, apartment, or duplex and renting it out to tenants. It's hands-on, yes, but it also comes with huge wealth-building potential. How it works: you buy a property, usually with a mortgage. You rent it out to tenants who pay you monthly. You use that rent to cover your mortgage, taxes, and expenses. Whatever's left, your cash flow, is profit. Over time, the tenants are essentially paying down your mortgage, while the property itself increases in value. That's a double win. 5. The benefits of rentals. Here's why people love rentals. Cash flow. A well-managed rental gives you steady monthly income. Leverage. You can use borrowed money, a mortgage, to buy an asset much bigger than your initial investment. Control. Unlike real estate investment trust, you decide what property to buy, how to manage it, and when to sell. Tax advantages. Landlords enjoy tax deductions, from mortgage interest to property maintenance. And here's a real-world example. Let's say you buy a $150,000 rental property with $30,000 down. You rent it out for $1,500 a month. After paying your $1,000 mortgage and $300 in expenses, you pocket $200 monthly cash flow. Doesn't sound like much, right? But fast forward 10 years. Not only has the property likely appreciated, but your tenants have helped pay down your loan significantly. That's wealth in action. 6. The downsides: real estate investment trusts versus rentals. Of course, no investment is perfect. Let's compare the downsides. In real estate investment trusts, you have no control over the properties. Returns can fluctuate with the stock market. Dividends are taxable as ordinary income. In rentals, you're responsible for tenants, repairs, and unexpected costs. Vacancies can wipe out cash flow. Properties are illiquid. You can't just sell quickly like a stock. So the question isn't which is better. The question is, which is better for you? 7. Beginner-friendly strategy. Here's my advice if you're brand new. Start small. If you're tight on budget, begin with real estate investment trusts. They'll give you exposure, build confidence, and let you learn. If you saved up some cash and want hands-on wealth, rentals could be your move. In fact, some smart investors combine both. Real estate investment trusts for passive growth, rentals for active cash flow. That way, you get the best of both worlds. 8. Mistakes to avoid. Let me save you from some painful lessons. Don't buy a property without running the numbers. Just because it looks nice doesn't mean it's profitable. Don't put all your money into one rental if it stretches you thin. One emergency could bankrupt you. Don't chase hot markets blindly. Prices can drop just as fast as they rise. Don't ignore property management. Whether you do it or hire someone, it makes or breaks your rental. 9. Long-term wealth plan. Now here's the big picture. Real estate isn't a get-rich-quick game. It's a get-rich-slowly but surely game. The goal is not to flip one property and retire. The goal is to build a portfolio, whether that's multiple rentals, multiple REITs, or a mix of both. Over time, the cash flow grows, the equity compounds, and the wealth snowballs. Imagine owning 3 or 4 rentals, each bringing in $300 a month in cash flow. That's nearly $1,200 monthly income, passive. Add in dividends from REITs, and you've created a financial safety net that grows while you sleep. So to recap, real estate is powerful because it creates multiple income streams. Real estate investment trusts are beginner-friendly, affordable, and hands-off. Rentals offer more control, higher potential returns, but require more work. The best approach? Choose based on your lifestyle, your budget, and your long-term goals. Now here's your challenge. Take one small step this week. Maybe research a real estate investment trust on your brokerage app. Maybe run numbers on a property in your city. Action is what separates dreamers from investors. If this video helped you, give a like, subscribe, and share it with a friend who's been curious about real estate. And let me know in the comments, would you rather start with real estate investment trusts or rentals? I'd love to hear your thoughts. Thanks for watching. And remember, real estate investing doesn't have to be complicated. Keep it simple, stay consistent, and let your money work for you.